Hey, what's up? It's Emilio Despirito, and this is the Wealth Architect Podcast. I'm so excited to be here with you each and every single week. My team and I have hand-selected our guests to come on the program to talk about how to build wealth financially, mentally, physically, spiritually, right? There's so much that goes into building a lifestyle full of wealth, and we hope that this content really reaches you, not only in your brain, but in your heart, and that you could do something with this. So thank you so much for tuning in. God bless you, and we're going to have a great show. Hey, a special thank you to our sponsor, Annie Mac Home Mortgage, whose Cash to Keys product is disrupting the industry. Sick and tired of finding the perfect home, not having your offer selected? I got to tell you, it happens all the time. With Cash to Keys, Annie Mac gives sellers a cash guarantee for each of their buyers' offers. Stop bidding and hoping. Instead, bid with Annie Mac and bid with confidence. Don't just bid, but win. Annie Mac Mortgage. When you're buying real estate, you need somebody that understands the ins and outs of the legal ends. It's so important to have the right attorney working for you. You also need a bulldog. Let me tell you something. The first time I sat in a conference room with this lady, Melissa Delana of Delana Law, I immediately knew she owned the room. You need an attorney that owns the room, that can solve problems and make things happen when everybody else can't. You want to hire Delana Law in Massachusetts, Connecticut, or Rhode Island. Delana Law delivers every single time. They're going to help you out with all of your real estate needs. It's delanalaw.com. You got to check them out.
Hello, everyone. I'm Walt Buteau in for Emilio Despirito on The Wealth Architect. This is episode 10, joined by Jeff Swiderski. He's the originating branch manager with Annie Mac Home Mortgage Momentum Group. Jeff, thanks for joining us.
Yes, sir. Thank you for having me, Walt.
And we are talking about sort of the economics of home buying, home selling, home holding.
Yeah.
Right? Real estate in general.
Yeah, absolutely. And, you know, it's funny because you go to Thanksgiving, you go really anywhere, and everyone always says, you know, they're waiting for home values to drop. They're waiting for, something that, probably isn't supported by data. And I think that's where a lot of my passion for the economic side of real estate came from. Is you hear all of these theories and see all of these headlines, and it's all of this information that's just out there in the general public. And a lot of it is just so easy to debunk with one chart or one graph or looking at any data set. And it kind of drives me crazy because, how many people are around in the world and they're logging into, whatever website or watching whatever news program, and they're getting misinformed. So that's, again, where a lot of it was born out of for me.
As a member of the media, we call it feeding the beast. So when you have multiple channels and websites that only do real estate or only do the economy, only do that, they are feeding that beast. So they are looking for headlines. I have a newsletter, so I look for headlines on it. So I look for 3 to 4 a week that I think are interesting, and it amazes me how from week to week they contradict each other. But in recent days, let's say it's episode 10, we're toward the end of October. In recent days, during this time frame, what have you seen maybe that has bothered you the most when you talk about seeing something that's easy to debunk?
So one that is very popular out there is always, it's kind of twofold. So tied to the Federal Reserve and the Federal Reserve moving rates and that having just a profound impact on mortgages directly.
I'm with you on that one.
And, it's funny because the market always knows what's going to happen ahead of time, right? Like there's no such thing as a data surprise anymore. Like people on Wall Street, that's all they do. Algorithms, that's all they do is they just study every news point that comes out over the course of, days, hours, minutes, seconds, things that the human brain probably can't even comprehend. We have so much data computing in the background. So when the Fed is going to make a move on rates, the market knows it probably 30, 45, 60 days before. And you can actually chart that and see where, the Federal Reserve is going to lower rates by 0.25% in mid-September. And you can see rates start to come down 45 days before. And then if the market doesn't like what the Fed actually says on that day, you'll see rates come back up. So I wouldn't say 9 times out of 10, but the majority of times you actually see rates react negatively during a Fed rate cut because of the other additional data points that come out.
Because in a way it's already reacted. Is that what happens?
Yeah, we call it baked in the market. So, it's already baked in. They already know what's coming. And then it's just a matter of what are they projecting into the future. That's the important piece. So, trying to front run the meeting, you should front run it by a month.
And the meeting is coincidentally, as you bring it up, this week, right?
Yes,
and
yes.
it's expected to lower the rates again. But
Yes.
again, I think a lot of people, and I got to be honest, I think realtors sort of perpetuate this sometimes.
Sure.
Because they probably don't understand it themselves, some realtors. And I think it's important to note, I think some people really believe when the Fed lowers that rate, that they're lowering the lending rate for loans, and it's just not true. And there are other factors
Yes.
that have to do with that. But all that said, a year ago we were pushing 8%, right? We were approaching 8% a year ago.
Yeah.
And now, and so we're down a lot in a year, but still higher than those days of 3%, 4%.
Yeah, and in that, that's really a perfect segue of what the Federal Reserve can and can't control. So their policy is going to be twofold. One is just controlling short-term interest rates, which, as you kind of alluded to, it doesn't directly impact long-term rates. So when you're thinking about a mortgage is 30 years, what the Fed is doing to a rate that affects something on a month or a year basis, that's such a wide spread. Think of how much different, of a return you would expect for 1 year versus 30 years. It's, that's a lifetime. So that's why there's less impact there. What matters more is the Fed as an investor. So the Federal Reserve carries a balance sheet behind the scenes. They're like any other investor in the marketplace. So they can buy US Treasuries, they can buy mortgage bonds. And if they're doing that, then they're adding demand to the market. So, think of any supply and demand relationship. If there's more demand and the same amount of supply, that's going to pull rates down because there's more demand to buy those.
Because the Treasury notes have a bigger impact than anything, right?
Exactly.
So looking at that, are they buying or selling, or have you noticed, or has the Fed been buying the Treasury notes?
So they did a lot through the end of, really the entire pandemic, but that's what drove rates to those historic lows that you're talking about, and drove that, really feeding frenzy in real estate for, we'll say 2020 to, the early part of 2022. And then the Federal Reserve flipped the script. And as soon as they did, instead of buying bonds, they went to the point of they're actually rolling them off or selling them. So their balance sheet is going down, and it's been going down pretty dramatically. This meeting, and again, that's why it was a perfect segue, so kudos, they're actually going to talk about whether or not they're going to continue selling bonds or letting them roll off at the same pace. If that reduces, that's where you actually can see some meaningful declines in long-term interest rates, including mortgages.
That in some ways, that lead, as we say in the business, burying the lead, that will get buried,
Yes.
except perhaps in certain publications that know it better.
Yes.
And so that is something to look at more than the actual lowering of the rate, correct?
Absolutely, and it'll be funny because you'll probably see that headline: the Fed lowered rates by 0.25% and mortgage rates got better, and it's going to be more so if they do talk about impacting buying and selling bonds. You're spot on.
But even if they did talk about it, the media would have to note that they talked about it, and I think. Because of the turnaround, not to criticize the news business, but because of the quick turnaround, and because reporters are younger and stressed and looking for the big headline, they may not know that, and they may not be, which is more important, report it.
Yeah.
But are you able to get minutes and know what they said? Someone like you.
Yeah. So, there's always a meeting after the Federal Reserve announcement where Jerome Powell gives a long press conference. They ask him a ton of questions. So it will come out in that. That's where a lot of that will come out. But then usually about a month later, the Federal Reserve actually releases those meeting minutes, and that will be poured over even more. So, and that's back to the algorithms. The algorithms are going to interpret every single word of what Jerome Powell says during that press conference, which, again, the average person isn't. And then when that meeting minutes comes out, they'll pour over that as well. So that's where we learn a lot more about the long-term direction of rates. But all of that to say, you should see rates continue to decline into next year because of all of those factors. The Federal Reserve is lowering rates, but more importantly, they're going to have more of an impact in the actual bond market itself and buying and selling securities.
In my newsletter, Walt's Window, a shameless plug, there was an article that I republished regarding a prediction of 5.5 by next year, and how that will bring another boon to the market. Now, and one thing I found interesting in that is that the percentage of people who have rates under 3 or even under 4 is not as high as we think, correct? It's and with that, I mean, the impact's not as big as we think.
So, and it's funny because they're same thing. It's easy to chart this stuff now. It's kind of the cool age that we live in between AI and the internet, coupling together. You can pull almost any information and any data point you want now in real time. So whether you looked at it on a national scale or a local market scale, you can actually look at that and show where rates under 4% and rates under 3%, more so under 4%. It's funny what that 3 number, like literally 3 to 2.5, the people in that range, a lot stickier. They don't want to give up those loans. But if you get from 3 to 4%, that rate of, percentage of outstanding mortgages is declining pretty rapidly. And the rate of mortgages over 6% as a market share has gone from probably 8% to somewhere around 20% of outstanding mortgages. So yeah, I mean, it's the curve is like this. It's happening rapidly. People have to move, whether it's you have another child and you need another bedroom, whether your living situation changes, divorces happen, job changes happen. There are so many factors that are going to play into that, yes, our market is a little bit more locked up than what you would expect based on our population. But in terms of it being gridlocked, it's impossible. We just have, too much of a need for housing.
We also want to talk about, building wealth through real estate. In a market like this, when you get a loan for a multifamily, the multifamily is high priced, tough to get the rents to support a big mortgage.
Can be.
So you got to put some money down, obviously. And I think they have slowed down in the sales of multis. I know that from just experience, but there's still I don't think there's not a lot of inventory, more than last year in the multi market, but not a lot. So when you start talking to somebody about building wealth, is step 1 your personal home and step 2 that investment property? Or how do you look at that?
It really depends on the individual goals, which I know is not a great answer, but it does. If I could tell anyone, sub 30 years old to go out and buy a multifamily, I think you just hit the nail on the head, because you look at rental rates across the country now and where they've gone for, a 2 or a 3 bedroom specifically, even 1 bedrooms are expensive. But once you get to that 2-3 bedroom area, those rents have exploded. And, part of that is the fact that prices have gone up and carrying costs have gone up. So landlords need to price it higher, but it's also just an inherent lack of supply. Housing in real estate, the wealth portion is always just so simply boiled down to supply and demand. And whether you look at Freddie Mac's data or NAR's data, it doesn't matter where you point, we're somewhere around 1.5 million units short of where we need to be. And that's whether it's actual ownership or rental. So if you're 1.5 million units short of what our population kind of demands, then what's going to happen? It's going to pinch prices higher because, number 1, people know they can get it. And number 2, it's back to the supply and demand. If you have 50 people lining up to buy the same product, it always drives up the value of that product. That's why things get resold online for, 4 times what they sold for 2 weeks ago, because there's just scarcity. So yes, to kind of bring that back to your question there, if you can buy a multifamily and have the other unit or units pay even a half of your mortgage, all of a sudden your portion is less than what you would be paying for rent.
Right.
And you're building wealth. Again, to your point, there aren't a lot of multifamilies on the market. So if you own one and the value of that asset is going up, even in a slow time, 3, 4, 5% per year, if you own a $500,000 asset, you're talking about $15,000, $20,000, $25,000 a year in equity growth. It's a lot of money.
And for decades, we hear quotes from people as far back as Benjamin Franklin about real estate, and you hear these among our first multimillionaires in the United States, quotes about real estate. It has always been the thing. I think we get into a fear, and it's a lack of really perspective, in my opinion, where we see prices doubling for a multi in Rhode Island, let's say. I sold one for $260 about 5 years ago, ran to the bank because I paid, I think, $110, but it's now, it's worth twice that again. And I thought that was the top, right?
Yeah.
So talk about the fact that if you hold real estate long enough, it may go up and down. You might buy something now. We may come down in price. I'm not sure we're going to, but we could.
Yeah.
But if you hold it, it just is probably, in many cases, the best investment out there.
So, you can almost say that for any asset class. We'll bring this back to real estate in a minute. But if you look at a million different metrics, but we'll focus on government debt. So, government debt has gone up over $1 trillion again this year. We're over $38 trillion in federal debt, and people look at that number and say the whole system has to collapse. We made it. That happened in 1980 when we hit $1 trillion in debt. Or whenever it was in the 80s, when we hit the first $1 trillion in debt, and everybody said this is unsustainable. The sky is going to fall. It's going to happen, and guess what? Never happened. Exactly that. It's just here we are trucking along. Whatever 35, 45 years later. So what actually happens is 50% of government revenue, so tax revenue, is just from income taxes across our population. Another 35% of that is still income tax. It's FICA taxes, Social Security taxes, Medicare, like all of those things that are coming out of our paychecks. So 85% of government revenue comes from taxing the working people in the country. Like literally, that's insane to think about, but that's how the government pays its bills. So $38 trillion in debt, and 85% of it comes from people making money. So guess what has to happen? People have to make more money. Like there's no such thing as wage declines in our country because the government always needs to spend more money. And that to me is a dynamic that I don't think enough people understand, is that wages are always going to go up. In some jobs, whether it's union, hospital, like so many jobs, you have a defined plan of how your wages are going to grow. You actually know what those numbers are going to look like. So if you start to think in that mindset, I'm not saying spend tomorrow's money today, but that is what our government's doing. So in saying that, asset prices also have to go up because it's back to supply and demand. If you supply people with more dollars, then those dollars are going to chase the same number of assets and it's going to drive those prices higher. So whether that's gold, whether that's stocks, whether that's real estate, asset prices by the nature of our economy have to go up. And again, it might not be a perfect like this, it might be ebbs and flows down, a little bit sideways sometimes, but no matter what, long term that it's going to start here on the left and it's going to go up. Like it has to happen unless our economy completely changes, which we're not prepared for that day.
And it's the ebbs and the flows that I think make people nervous, and it's really about patience at the end of the day.
So a fun national data point, Case-Shiller, the largest kind of metric for what home values do in our country, and that's not looking at median home values. That's looking at actual, if you sold your house today and you sold your house in a year, how much did the value of that one individual property go up? I think that's important because median value is just the mix, right? If $10 million houses sell and $100,000 house sells, the median is $1 million until that many lower price houses sell. It's, it's not changing in terms of the actual percentage change. Versus if a house is appreciating by 5%, that $1 million house is now worth 1.05, but it's going up accordingly. So why is that important in that conversation? When you look at Case-Shiller, that's what they measure, is how much has this house gone up relative to its own value year over year. If you look back to World War II, so we're talking about an enormous sample size, we're getting close to 100 years now. In 2007, 8, 9, 10, 11. Home values declined. Outside of that, you did not have 1 year in that entire data set where real estate went down by a full % year over year.
Say that again, because I think it's worth repeating. 3 years. So 3 years in 80 years time.
So the financial collapse, which we can talk about that if you want to in a moment. But so there was 5 years around the financial collapse. It was 2007, 8, 9, 10, 11. So those 5 years, if you take those 5 years out, since World War II, there has never been 1 year where real estate values nationally fell by a full %. There was one other year where they fell by 0.7%.
One thing I harp on sometimes is the national data, though.
Yeah.
Because obviously, to me, it's real estate's hyper local.
Sure.
And we see that in appraisals.
Yeah.
And I hear that from customers of mine now who are wondering, why did this house sell and you have mine listed and it didn't sell? Well, that house sold in April.
Yeah.
Oh, and that house is in a different city.
Sometimes same city, different neighborhood.
We're right.
Yeah.
We're right. Exactly. Yeah. That's right. And so with that, I mean, the national data is sort of, it's sure, I believe that, but obviously there are those pockets of issues that people might notice, whether Rhode Island, Florida, right now, Florida, for example, Florida's tanking a little bit.
Well, and it's funny because, you almost just pointed right to it, but there are parts of Florida where home values are still going up.
Right. That's right.
It's absolutely.
I was going to say that when I said Florida's tanking, because you're right. And by the way, tanking is a relative term.
Right.
It's not going to tank, I don't think, all the way down to 21 values.
So let's talk about Florida, and then we'll spin that back to national, because I do agree with your point. Like, if you look at national data, right, like there's always the largest metros that they talk about, the big 20 cities, and it's easy to find the data on those. But if you look at just nationally right now, the Northeast, the Mid-Atlantic, the Midwest, all performing wildly well in terms of wealth building and real estate. Values are going up, still almost all of those markets, sellers markets, a lot of competition for properties. And then you look at Florida, parts of Louisiana, Texas, Arizona, parts of Colorado, California, parts of California. That's where you see home prices actually pulling back a little bit.
But you just mentioned some of the Austins, the Nashvilles, the Denvers, Tampa. All these were the stars.
They went parabolic.
They were going great, and so you have to know, like, if there's one thing people get from this, you have to know, you're gonna have. Is it a correction? I don't know, but it's definitely. It can't go up forever.
Yeah, and
that's what we're seeing.
Well, that's back to it not going up in a straight line. Ultimately it is going to go up forever.
Yeah, that's true. Right.
But maybe it goes like this. And there's just a little weak pocket.
Have you ever heard of upfront underwriting? Well, I haven't until I started working with Movement Mortgage. Movement Mortgage is one of the top loan originators around the country. Specifically, I want to give a thank you to Matt Bates. And if you're lucky enough to live in Rhode Island, Massachusetts, Connecticut, or New Hampshire, I strongly suggest you contact Matt Bates at rimortgageguy.com. Again, rimortgageguy.com, and he's going to help you to find that dream home. He does upfront underwriting, which means they fully approve you for a mortgage before you even place offers, increasing your chances of winning that dream home. rimortgageguy.com.
It's funny because it's back to like coming out of COVID, right? So the pandemic, the government printed so much money and artificially, lowered mortgage rates to a point where everyone felt like they could afford anything. That was the reality. So what happened in a lot of those markets? People had remote work. They thought they could now live wherever they wanted and work wherever they wanted and still make the same amount of money. So they looked at those markets and said, well, Nashville's underpriced compared to where I live in New York or, LA or, wherever they were. And they said, I can get better bang for my buck. So then there was so much more demand poured into there. Like, there was the mass migration that they called it from California to Houston that you were just talking about.
And Florida too.
Yes, so many people moved from California to Houston during the pandemic, all the same reasoning. And it put so much more demand in that market. Same supply, more demand. It's back to real estate's always going to be that simple, supply and demand. So it put so much more demand in those marketplaces that it just sent them to the moon. And then think of how many places have called people back to work, even if it's only a couple days a week. It's hard to commute from Houston to LA. Most people aren't hopping on a flight for Monday, Tuesday, and then going home on Wednesday. So a lot of those people looked at it and said, well, maybe I should sell. And what did that do? It created more supply while the demand was leaving. So, it's all relative. Florida's an interesting case study. They got whacked by 3 Category 5 hurricanes in a short amount of time. Insurance rates went through the roof. They changed all of their guidelines around condos and condo complexes after that condo collapse.
Yeah.
Like, there are just so many different factors. And they did also have the mass COVID migration that ended fairly rapidly, as we just talked about. So, there are just so many factors there that I don't want to discount it because obviously, if somebody's feeling the pain down there right now, if they bought at the absolute peak and values did decline, it is tough, and, definitely sympathetic to that. But I still think the reality is what you said earlier, that if they hold that asset in, whether it's 3 years, 5 years, 7 years, they're going to come out on top. That's the other reality.
It's just whether you can hold it. And I think that
Right.
even happened during the crash from '07 to the people who were able to hold, even if they were a little underwater, got paid in the end. And that
Yeah.
was some of the worst things we've ever seen.
Yeah.
Now, we want to talk about building wealth.
Yeah.
So let's move into that. I think
Yeah.
a good segue that you just mentioned, because what we're talking about, you could build wealth in a bad market if you don't sell, right? When the
Yeah.
market, right?
Yeah.
So, and now I think people, again, you move, okay, you're going to make some money, but you're going to move somewhere where the prices are higher than when you lived there before. So it's not a perfect world. So what do you tell
Yeah.
people who are grappling with that sort of contradiction of terms? I mean, one quick note, my accountant said, I didn't listen to him, hold on to every house you ever buy.
Yeah.
And it actually makes a lot of sense.
It does.
But other than that, what do you tell folks?
Well, and it's funny too, because like everyone always says, I made X number of dollars in the stock market, or I made X number of dollars in real estate. Until you sell, you didn't make anything.
Right.
It's
Right.
it's awesome to watch
on
it go up
paper.
on paper and your net worth and all of those things. But until you sell, you didn't make anything. So, if you sold that property and then deployed it to do other projects and make more money, there's something to be said for that. That is the entire point of building wealth through real estate. So, let's look at whether you buy your first property as a rental or you buy your first property as a primary home. I think time horizon is one big piece of it. If you're going to plan on moving in 1 to 3 years, I don't know if it makes sense for you to buy real estate. That's always going to be my general feeling. Like somewhere in that range, like you could have a pros and cons list and you might do well, but I just don't believe in the risk part of it. So once your time horizon is beyond that, it always makes sense to buy. Like if you can, and you're going to be able to live comfortably and, not be trapped inside the four walls and hate your life, it always makes sense to buy, because over time you're going to be building wealth. One fun thing, I won't swear on the show, but if you know Charlie Munger, he was Warren Buffett's right-hand man. He always said the hardest part is saving the first 100,000. He says it's a B. That's the swear. Getting that first 100,000 is the hard part, right? And why is that? Because once you have the 100 grand, if it takes you 10 years to save the 100 grand, now it's invested in the market. It's going to take you 7 years to get to 200,000. Now you're at 200,000. It's only going to take you 4.5 years to get to 3, and then it's only going to take you 3 years.
Right.
And that time horizon gets shorter and shorter because it's stacking wealth for you. It's the same thing in real estate. If you own a $500,000 asset and it goes up 5% per year, it went up 25 grand the first year, but now it's going up 5% on a $525,000 value.
Right.
So it's compounding in the same way, just in a different way. The most fun thing about real estate is leverage. Like if you ever hear someone talk about building wealth through leverage, that is the ticket. If you have $100,000 in gold and it goes up by 8%, it's awesome. You made 8 grand. Like you sat at home and you made 8 grand. If you had $100,000 in the S&P 500 and it went up 11%, you made 11 grand. Like even better. Like good for you. And then people look at it and say, well, real estate only goes up an average of, give or take 5% per year. And it's like, well, you took that 100 grand and you put it into a $500,000 asset. So if that $500,000 asset goes up by 5%, it went up 25 grand.
Right.
Your investment was only 100 grand.
Right.
So you actually got a 25% rate of return on your investment. So that's the part that I think a lot of people don't account for when they discount what real estate and what leverage is doing for you. Now you put that on an investment property. You were talking about multis earlier. If you get that 4-unit multi and it's cash flowing a little bit, rents go up nationally 8% per year. So some markets are going to be infinitely higher than that, some a little bit lower, but that's national data going back almost 100 years, 8% per year. If you actually look at it as a business and you're raising rents regularly and keeping up with all the things you need to keep up with, if your rents are going up 8% per year and that number is growing year over year over year over year, and you're also building the equity behind it. All of a sudden, you borrow more money against that home because you can, you buy the next one, and all of a sudden you have this snowball compounding effect of, number one, building a portfolio, but now you have, whatever, $2 million worth of assets, and your investment was still only, 100, 200 grand, and that $1 million of assets going up, whatever, 5% a year again, is compounding, and all of a sudden your rate of return is 50% per year, something crazy. It happens fast.
You talked about briefly, you didn't use the term house poor, but you talked about being maybe overspending or spending so much you feel trapped in the home. But I will say, with the cost of rents, like I have a multifamily right now, it's a 2-bedroom on each floor. I don't have it. It's one I'm selling for a client. 2 bedrooms, 1 bath on each floor, about 1,100 square feet. Now that's a $2,200 a month a property now, but that could be a mortgage. Even if it's a condo, it could be a mortgage. And when you think about that, let's say you find one of the few $200,000 condos or $300,000 condos. They're out there.
They are.
They're pretty good, actually. Now you get to 300, you're getting a decent condo. It's not perfect. I'm about to list a condo in Pawtucket that's going to be $200,000. It's a basement condo, but still the same philosophy. You theoretically could buy that. Let's say you go FHA. Let's start with a $200,000 condo. Let's start with a person out there who is just starting out and goes, I can't buy a house. But let's even go $300,000 for a piece of property. If I'm FHA, what do I need to put down on that?
So, and that's the fun thing is, like, depending on where it is, whether you're going USDA or using a local bond program, or there's a lot of even like hybrid type private bond programs now where you can get down payment assistance. Half the time you almost don't even need to be out of pocket. But for conventional or FHA financing, just the big two, you're looking at 3 to 3.5% down as a first time buyer.
So 10 grand, let's say 10 grand could get you into a $300,000 condo.
Yeah.
Now, of course, finding it is going to take some patience, but it happens.
Yeah.
I think I spent a year with a local police officer finding a place, but he eventually found one, and it worked, right? I think it was $250.
Yeah.
Tough range. But regardless, you've put $10,000 into this $300,000 condo, and let's use your math from earlier. Again, average increase, and it's average.
Yeah.
So if you have a 1% year, you're probably going to have somewhere down the road a 9% year.
Right.
It's going to average out to be about 5%. But in a year, you've put $10,000 into it. You've paid. You got a tax write-off because you're most of it's interest, so you have that. You didn't have that with rent, right?
You didn't have
your
that
mortgage
with rent.
is going to be similar to rent probably, and now in an average year, $300,000 goes up 15 grand.
Yeah,
you made 15 grand on a $10,000 investment. That's why, again, we've said it forever that it's the best real estate. It's the best way to grow wealth out there.
And that is the key to leverage, and that's the key to, getting in early. Like it's such an age-old and cliche thing, but time in the market versus timing the market. You're never going to pick the exact right moment when the bottom was, and you're not going to throw a dart and say, this is as cheap as this property is ever going to be again in history. But 9 times out of 10, when you're buying, that is true. That's the point of what we're saying, right?
Right.
It is almost always going to go up. Plant the shade tree 20 years ago or today, buy real estate 20 years ago or today, because you have the entire historical framework of our economy to tell you that it is going to go up. And in that scenario, you look at, there was a recent CNBC article that feeds into this exact thing. And it says that if your parents were homeowners, you are statistically, it was like 40% higher or something, more likely to also be a homeowner. And it's just that kind of, somewhat trickle down effect or appreciation effect, but it's easier for that person to look at their parents and see how much wealth they have in real estate, and they, naturally feel more secure in buying the next home for themselves. Why? Because they can look at that math and see the benefit and see what it did for their family. 60-something% of middle-class wealth is tied up in real estate. There's a reason.
And going back to our parents, the baby boomer owns, I believe, this number, I remember publishing it, but I don't remember the exact number, but I believe it was over half of our real estate wealth or a high percentage of our real estate wealth is controlled by the baby boomer, which is remarkable.
It is.
And it also is somewhat of a problem right now.
It is.
Because they're not going anywhere.
Yeah.
Some of them, and I have clients like this, they want to go somewhere, but they can't find where to go. So it's this logjam and a domino effect.
Yeah.
But there's a lot of people in second homes or even first homes that want this second home owned by the boomer who is like, where am I going? I need a ranch. Everybody thinks their knees and hips are going to go.
Yeah.
And we don't have enough one-floor properties.
We don't.
They go quickly.
Yeah.
I have a 2-floor property where it has a first floor bedroom, and I advertise it because I had somebody there last night. They need a first floor bedroom for their mom. And so even if you have a first floor bedroom, it is something people are looking for. So is there anything that unlocks the key, pun intended, to convince those folks? Probably don't have any rate. A lot of them might own an outright.
Yeah.
Do you deal with folks like that, and what happens so that the person that wants to continue building their wealth can buy a little bit bigger home, the second home, third home?
Yeah. So, do you mean more so for the downsizer or the upgrader?
So the person who's the downsizer and the upgrader, they're kind of at odds.
Yeah,
the downsizer is the one that sort of needs to move to increase that supply.
Yeah.
And then the question is, where are they moving, I guess?
Yeah. So, I mean, you can look at it from both ends. So you're spot on with what you said earlier. So 40% of homes in the United States are owned outright. Literally almost half, which is crazy. And then of mortgaged properties, 60% of the home is owned as well. So we're at like a 44% loan to value, meaning mortgage amount relative to real estate value in the country on mortgaged homes. It's like the American consumer has never been in better financial shape in terms of debt relative to asset value. Like historically, it's the best it's been in like 55 years or something. It's crazy. Like people are wealthy right now. So it's usually more so just finding the actual plan or path. Wealth architect, great name. Like you're looking at your blueprint, right? If you give someone, hey, this is your starting point, this is your finish line, they're overwhelmed. They're immediately overwhelmed because they're not looking at, step 1, step 2, steps 3, step 4 to get there. They're looking at, how do I get from here to there? And they lock up. People are naturally, averse to change anyways. And they say it's easier for me to just stay here, whether it makes sense or not. So for the baby boomer that's looking to downsize, that's usually the key, is just they need the plan in front of them. You shamelessly plugged earlier. I'll shamelessly plug. We have a cash to keys platform that is designed around exactly that. Our entire goal, mission, everything is to unlock housing for people that are looking to downsize or looking to move in a more seamless fashion, a more cost-effective fashion, just basically removing that entire barrier. But not everyone is looking at the plan that way. So they're looking at it and getting overwhelmed because they're trying to get from here to here without having someone lay out all of the steps in between. For the downsizer, it is hard because you're right. Like, I think it was right around the early 2000s, the average home size in the country ballooned. Like we went from 1,000 square foot house in the 70s to a 2,200 square foot house by the early 2000s. Like around here locally, I say it all the time, but you can think of all of those subdivisions that were put in, and they were all, the colonials that were, 2,400 square feet. Almost all of them were built then. They were built from 99 to 2007, like all of them. That was why our supply was so huge nationally too. Builders just fell in love with throwing up a little bit of a bigger house because that's what everyone wanted. But in doing so, it replaced a lot of that, quote, entry level housing and the downsizing housing. A lot of it just got eviscerated by larger scale homes. So that is the hardest part, is there's just not a lot of supply of those homes.
Yeah.
They just, and it's not so much that there's not a lot available on the market. It's just that there's not a lot of them that exist anymore. When you drive around, you don't see a lot of 1,100 square foot ranches anymore. It's just not the norm.
Yeah. And that may not change, because when you look at builders, and, Rhode Island especially, but even nationally, you look at builders, I think in Florida, I think you see it a little bit on the outskirts of the cities where they are building the 12, 13, 1,500 square foot starter home.
Yep.
But I think here, if somebody gets a piece of land, because as Mark Twain said, buy land. They're not making it anymore.
Yeah.
And if somebody gets a piece of land, it's difficult. They spent a lot. So to make money, they need to build the beast.
Yeah.
3,000 square foot.
Right. Yeah.
And that's just, I mean, there are people who don't realize I don't need that big a house.
Yeah.
They still sell and they sell quickly. But I don't see, I know one builder that's building condos, but they're freestanding condos and they're one floor. And those are, but there's not a lot. So nobody's building that. I think it would be something for a builder to think about if we had the land here, but even elsewhere, almost like a Levittown. If you could build a Levittown, a bunch of ranches, 1,000 square feet, 3 bedrooms, 2 baths, something like that.
Well, and you're spot on too, because you are seeing a little bit more of that. Those 55 plus communities where, you know, it's exactly that, you know, like you're driving down the picturesque road and it's, you know, the perfect little neighborhood with, you know, a couple of trees and everybody's walking.
Somebody mows your lawn.
It's, you know, but think about it. That's an ideal scenario for most retirees. I don't have to shovel snow. I don't have to mow the grass. You know, whether you're north, south, doesn't matter. It's all relatable. You don't want maintenance at that point in your life, whether your goal is to spend more time with your grandkids or your goal is to travel, whatever it is. You want to spend less time and money on those things. So it's kind of a nice utopia.
But it is a utopia because it is competitive,
of course,
for those loans to get some of those properties. If you're talking to somebody starting out right now, what's the first thing you want to tell them? Obviously the data is great. How do you get them from the couch to your office ready to take that dive? Because it's just, if you think back the first time we did it, it was scary. But it's not that scary the second, third, fourth time. So
it's easier. Yeah, it's like riding a bike. Honestly, that's why we're here. You know, I think, you know, again, we're trying to overshadow the majority of the news articles that go out there and say, oh, affordability's down, this is down, this is down. You know, people, again, are making more money than they've ever made, especially in those higher price markets. Like that's always the reality, right? Like if prices are higher, it's because incomes are higher. You need higher income to support higher prices. It's that dynamic is always going to exist. So what I would say is, you know, if you're looking at it and you are guessing at your numbers, or you're on, you know, one of the major websites and you're just plugging something into a financial calculator and guessing whether or not you can afford it, then you're kind of doing it wrong. There's a guy on Housing Wire, Logan Motoshami, is kind of a genius, honestly, in the housing world. But he said if somebody asks you the question, am I ready to buy a home? The answer is no, because you should have already, you know, done some homework and thought through it and looked at your budget and all those things. So that's what I would say is you have to want it, number one, whether that's regular wealth building through investing, through real estate, doesn't matter. You have to want it. So you have to be willing to put yourself in those conversations and look at some nitty gritty on what your numbers look like, what your cash flow looks like, what liabilities you do have. Maybe there's some advice that someone could give you on how to streamline and clean things up. We do that all the time. You know, sometimes people are paying 30% on a credit card and you look at it and, you know, they have a $10,000 balance and you're like, why don't you just open a zero interest card? And instead of paying, you know, the $500 or $600 a month in interest, you're paying it down by $500 or $600 a month, and you can get a 21-month no interest card. You know, it's just, but a lot of those things aren't realized until you enter the conversation. So that would be my advice to anyone: is be willing to put in a little bit of work, because that's the rest of your life. The little bit of work that you do today saves you 5 years of work on the tail end of your life. And again, in those 5 years, you're going to want to be spending the time with your grandkids or traveling.
And you know what?
Literally anything else.
That's sort of where both of us come in, because it is really like there's buyers or potential buyers come to me on a regular basis, usually through lead services, and they're just not ready. And they think, well, you know, I don't think I'm going to be ready till next year. I go, well, I'm selling a house next year. You want to write a mortgage next year. And I think, but it is a matter of them seeing the prize.
Yes.
The prize is financial stability.
Yeah.
And time is part of that. Mm-hmm. And so you and like you said, yeah, you have to want it, because you might have to make some sacrifices. Don't use the credit card, or, you know, we've all talked about don't go out to lunch 5 days a week. Don't buy the coffee 5 days a week, whatever it is. Use free coffee, like I do. And I'll tell you, because you will be you'll be in a much better situation. And I think well put, you said, work a little harder now at that. Get the knowledge, not just on the internet. Talk to somebody who can look at how you're spending and might say, hey, why don't you do this? There's $400 you saved a month. That's $5,000 in a year. That's halfway to that condo we just talked about, the $300,000 condo.
Yeah.
And be willing and understand this. I always tell people, you got to buy like a seller and sell like a buyer. And what I mean by that is you're probably not buying your final home. Some people are.
Sure.
But very few people do that.
Yeah.
So you got to look at that property. Can I sell this property? The answer is going to be yes, but it's going to be at a certain price. It's going to be this, and when you sell, you have to realize, okay, what does the buyer want? But if you buy that way and realize, okay, I don't want to live in a condo. Okay, fine. It's not forever.
Yeah.
It's for 2-3 years.
Right.
Maybe you build equity and you can use that equity. You save more money. You hold the condo. You rent it, and that's really how it's done, right? I mean,
it's funny you say that because you do get caught in that sometimes, right? Like you're looking at it and saying, you're in your 20s, early 30s, whatever it is. And it's like, well, that 4-bedroom house, that I really want is so far out of reach. And it probably is. But if you're taking those steps at that point in your life, it's not that far out of reach once you've built another $150,000 in equity in that property, and now you have that to carry forward and pay that down. And again, your wages have gone up all those years, so all of a sudden you're making more, you have more, and you can get there if that's your goal. But it's funny to think back to like the baby boomer generation, and you hear all like the country songs and things about like they had 4 or 5 kids under a 2-bedroom roof. Like that was reality back then. So you talk about sacrifice. I think over time we get really warped and almost I'll say somewhat spoiled, because like that 1,000 square foot house back then, they had more kids per household back then than we do today, and now we're talking about 2,500, 2,700, 3,000 square foot houses. It's having that perspective of if you really want to build wealth, sometimes it's a very minor sacrifice for a short amount of time to really springboard yourself and get there.
Yeah. Jeff Swiderski from the originating branch manager with Annie Mac Home Mortgage Momentum Group. Appreciate you joining us. And I'll tell you what, great information.
Appreciate it.
And the good thing about this, since it's not live, people can look back at it and hopefully, give us a call. We can help you. That's why we're here. I don't have to sell, like I just said, I don't have to sell you a house today. I can sell you one next year, but you really want to get in that game because it builds wealth, correct?
Yeah. And it all starts with a conversation. It's really not as pressure filled as people make it out to be.
And there are no dumb questions.
No dumb questions.
You ask the questions, and a lot of people are leery about asking questions because they think they should know something. Guess what? None of us knew it before we knew it.
Yeah.
Right?
Yeah.
Okay.
No, knowledge is power. Appreciate it, Walt.
Thank you, man.
Yeah, thank you.
Thanks for joining Wealth Architect, episode 10. Emilio will be back next week.